Hey everyone, welcome back to the Nadlin Forum Podcast Daily. I'm Ruby Sturt, and as always, I'm sitting across from the legendary Lior. Today, we're getting straight into the 2025 Q2 Homeowner Equity Report from Cotality. And yeah, it's kind of a reality check for anyone banking on big equity jumps this year.
Yeah, that's right, Ruby. The numbers this quarter are, how do you say, humbling. Last year, average homeowner equity gains were about $25,000 per borrower, but now it's just $4,500 for 2024. That's a huge drop, especially if you've been listening to us the past few years, feeling like everyone's house is a piggy bank.
Exactly. And just to ground it, US homeowners with mortgages are still sitting on $17.5 trillion in total equity. So, the bucket's still full, but here's the kicker. Year on year, we've lost $141.5 billion in borrower equity. That's a 0.8% drop. Not catastrophic, but it's definitely a signal the market's cooling. Here's a funny one. I was chatting to a bloke back home in Melbourne last month, and he was absolutely freaking out. He bought in early 2020, rode the wave, and now he's glued to the Cotality numbers like it's the weather report.
Everyone got used to those gains during the pandemic, right? I mean, average homeowner equity is still around $307,000, which is the third highest on record. But the vibe has shifted. Now, people are starting to worry, not just investors, but regular folks worried about whether their house is still a good investment. And to be honest, in some markets, it's getting tougher.
And it's not just the big picture either. Like when you compare to what we talked about a few episodes back, market access feels different for owners now. The easy money days, kind of fading, especially if you want to refinance or tap into that equity. But we'll circle back to strategy in a bit. First, we got to talk about some not so fun stuff that's lurking behind the averages.
Yeah, so let's dive into what personally for me is the most concerning part of the Cotality Report. Negative equity. We're seeing the percentage of homes where people owe more than the house's value increase from 1.7% to 2% year over year. That's 175,000 more properties joining the negative equity club. I mean, for some, that's not a huge number in percentage terms, but it's an 18% jump. People feel that.
And it's not just randomly sprinkled around the country either. The regional divide is wild. In the Northeast, Connecticut, New Jersey, there's still growth, like $37,400 gains in Connecticut, which wild. But then you look at places like Florida or Montana, and you're talking about equity losses, down $30,100 in Florida, down $26,900 in Montana. Total roller coaster.
Yeah. And Cape Coral in Florida is a real cautionary tale right now. I was working with some investors there, and honestly, the situation just keeps getting worse every time a hurricane blows through. The Cotality data actually lists natural disasters as a major culprit. So it's not just about market fundamentals, it's literally about properties losing value overnight. And some of those people were sitting on good gains just a couple of years ago. Now, not so much. It's making new and current investors extra cautious. Nobody wants to buy into a market with a bullseye on it every storm season.
You make a good point. It's not just Cape Coral either. We're seeing negative equity rise in places like McAllen, Texas, and Shreveport, Louisiana too. Meanwhile, cities like LA, San Fran, Vegas, they're not getting hit as badly. It's a pretty stark reminder. Location's always king, but risk isn't just about the local school district or commute times anymore. Market health, disaster risk, even politics, investors and homeowners have a lot to juggle.
Absolutely. And don't forget, even though the number of homes in negative equity fell slightly quarter over quarter because of the spring buying season, that doesn't mean the underlying problem is fixed. It's just camouflaged by the yearly rhythms. So if you're thinking about buying, refinancing, or even pulling out some cash, You gotta have your eyes wide open about local trends.
All right, so now we get to the real talk. What do we actually do with all this, right? So Dr. Selma Hepp, Catality's top economist, is calling it the slowest home price appreciation since 2008. She's predicting just 3% growth through 2026. So if you're chasing outsized price jumps, you might be left waiting a long time.
Yep. And that brings up a big challenge. Using equity to your advantage isn't as straightforward as it used to be. If your property's value isn't climbing, your options for things like refinancing, home improvement loans, whatever, are shrinking too. Especially tough if you're in one of those hit markets. Or if, like Ruby's mate in Melbourne, you're just hoping your house stops losing ground.
Look, I keep joking about trying to refinance my imaginary outback shack. Mate, the only thing appreciating out there might be the kangaroos. But seriously, it means you gotta ask a few big questions right now. Things like, do you actually know if your market's headed up, down, or sideways? Are you over-leveraged? What happens if your home loses another 10%? I mean, even preparing for a rate cut, like we discussed a few episodes back, changes when your equity's stuck or sliding.
Exactly. And I'll say it one more time. Don't get caught up in the national headlines if your local market is telling a different story. Before you touch your equity or sign up for any big refinancing deal, check in with a professional, run the numbers, and seriously plan for less rosy scenarios.
Could not agree more. This is really one of those hope for the best, prep for the worst sort of moments. All right, folks, we're going to leave it there for today. Lots to chew on. We'll keep tracking this and, I don't know, maybe next episode I'll have a new shack to refinance. Lior, always a pleasure.
Always, Ruby. Everyone out there, stay sharp, watch your numbers, and as always, stay tuned. We'll talk soon. Bye.